Hi, and welcome to Crypto for Advisors, a podcast by Synergist. More than a third of Australians are into crypto, yet nearly 90% of advisors will not discuss it with them. I believe this is exposing investors to unnecessary risks, compromising the value of advised relationships, and limiting investment performance. My goal is to educate advisors and investors to bridge this crypto service gap while strengthening advised relationships. So let's get into today's episode. Welcome to Crypto for Advisors by Synergist. My guest today is somewhat of a unique beast. He's a lawyer who runs Cadena Legal based in Brisbane, but he's also worked in Web3 startups from the inside. He co-founded Juby DAO, which streamlined on-chain token admin. This led him to start Bluebird, which offers a broader proposition to assist Web2. Web2 is the internet that we all use today, into Web3 businesses. Web3 is the internet underpinned by decentralized blockchain and crypto infrastructure. He also works with Black Sheep, an Australian startup making it easier to buy and sell crypto with Australian dollars. So I think that probably makes him not only one of Australia's most active Web3 entrepreneurs, but also one of its most qualified. So welcome to the Crypto for Advisors podcast, Harry Dell.
Thanks, Andrew. I think it makes me the one with the least free time as well.
The sign of a good entrepreneur, right?
Yeah, I think so. It's look, you see problems, you see them from the inside as a lawyer, and some of them are just so frustrating. You've got to go and fix them yourself, unfortunately. So it's a curse as well as a blessing.
You see problems as opportunities, right?
Yeah, you have to. Otherwise, you'll cry, I guess.
Yeah, exactly. So, Harry, we're going to go through three topics today. The first is tax and super, and then we're going to have a chat about the regulatory misalignment that seems to exist at the moment in Australia. And then thirdly, we'll look at some trends, tokenization, DeFi, stablecoins, whatever comes to mind. We aim to give our audience key insights into the changes happening to the advice industry regarding digital assets and what they can do to position themselves to create a strategic advantage while staying compliant. So, Harry, in your own words, the Australian government dropped a bombshell last week with the Board of Tax releasing their recommendation to government on tax treatment of crypto. Did this bomb blow up industry progress, or did it clear a pathway for a productive future?
Well, I think it's sort of a bit of both in that it was a really thoughtful report, really detailed report, enjoyed reading it, but it eventually recommended a wait and see approach. And in my view, and I think most advisors' view, that the wait and see approach is over. We've been waiting and seeing too long. We've got other jurisdictions already doing a lot of things in their tax and super. This is that side, the whole regulatory side. There was a whole other bombshell with Treasury, as well as Labor announcing their policies through the media and all sorts of things. It was a very busy week on Friday afternoon last week, unfortunately.
So from a tax and a super point of view, what are the key impacts that have come out of this paper? You said it's a wait and see approach, but does that provide more clarity at all, or is it just the maintaining the status quo?
Well, it gives clarity by telling us that they're going to be maintaining the status quo as it is.
Yep.
While no legislative reform was recommended, they did say ATO guidance needs to improve specifically, as well as have some working groups, which I hope I'll be a part of. I was a part of the Board of Tax process as well, which was really, really good. The disappointing bit is some of the recommendations are around things like timing of realizing tax on crypto, for instance. It should really only be when you have an economic gain. That's when you should pay tax or potentially pay tax. You shouldn't pay tax when you don't have an economic gain. It's just the law deeming things to be realized. And the one that comes to mind is token-to-token swaps, particularly things in DeFi, like when you're wrapping tokens, bridging tokens. ATO default approach says it's token for token, so it's a tax event, which is really inappropriate. Board of Tax saying that's inappropriate, but also recommending no legislative change is really disappointing, because we've got like 12,000 pages of tax laws. Last I checked, it's probably more now. I get that I want to add more fuel to that fire, but it doesn't work very well on those fundamentals like timing.
Yeah.
And to say no legislation needed, and also say, but that's inappropriate, it's a little bit confusing for us as advisors. But what we do know is we don't expect anything to change, which is both good and bad. It means we can plan for the future, but we wanted some change.
So you seem to have two camps forming at the moment. It's the camp who are saying, well, we want to retrofit existing laws to squeeze in digital assets and treatment of them. And then other camps saying, well, no, we need a different framework for digital assets. It sounds like you're falling into the latter camp, are you?
Not really. I'm actually, I'm a boring centrist, but, stating my actual position, it's, we don't need reams and reams of new laws. What we need is those thoughtful adjustments. And then we can use those existing regimes. We can't use the existing regimes without those adjustments, is my view. A lot of people have said we need a whole new thing, a whole new department to look at crypto, a whole new raft of legislation. And, Kerry Packer, I think, really had the right approach here in that, more legislation isn't going to fix it. We need to take some away, and we need to make those fine-tuned adjustments to make it actually work. The camps came sort of about with, I think it's practical to recommend less legislation. If you want government to rewrite the entire book, frankly, it's not going to happen. With the tax law, they tried to rewrite that book in the 90s. What happened? They ran out of money. Halfway through, they just enacted what they had. That's why we have 2 tax acts. We aren't very good at reform in this country. We're very, very slow. It's very cumbersome and expensive. So we're better off to get an outcome to make those adjustments to what we've got. That's my personal view.
There's 3 basic objectives of any new legislation or regulatory approach, and that's to protect the consumer, to create innovation and growth in industry,
Yes.
and to create an effective or efficient market. It sounds like that first objective is probably the one that's getting 50% or more weighting, and it's a bit of a fear-based approach. Whereas if you look at other jurisdictions like UAE or Singapore, even be interesting to see what the states come out with, they seem to be leaning much more heavily into the innovation and industry approach and saying there's other consumer protection laws and corporation acts which give consumers a lot of protection. We don't need to overwhelm it. And if the market's inefficient, we'll adjust it.
Yeah, and the market should do it itself. Doesn't always, we have Hawk 2 coins and all sorts of things. And that's the free market at play.
Look,
so we need
Donald
to be
Trump's coins.
Donald Trump's coin. So you can't release a coin in the US unless you're the president. That's what that told us.
And it's 2 weeks before you take office.
Yeah, exactly. Australia has never been a place to run a global business. You'll notice that, none of the top companies in the world are effectively based here. The largest one that I can think of is Atlassian. And the reason that they're here is because their R&D expenditure was here. And also the founders are Australian based. So that's just where they built their team. Look, they've had their own international tax journeys. That's a whole other thing of mine, but that's not for today. But Australia's just never been a fast enough follower in innovation. When Silicon Valley was taking off early mid 2000s, it wasn't until 2015 that we changed our employee share scheme rules to actually allow you to give equity in your Aussie company, in your startup for, pretty low effective cost. It's too long. And even if it wasn't too long, that 30% headline tax rate on companies and just a high reg, high compliance approach, very small market, very isolated time zone as well. Now we're away from the big, European and US time zones. We're pretty close to the Asian time zones, and we've done some great stuff in those markets. But then why would you head here? You'd go to Singapore, you'd go to Hong Kong. And if you're looking for Europe, you'd go to the UAE. There's a few other countries there that are really progressive, particularly for exchanges like Lithuania, Switzerland. There's even some of those islands like Guernsey, Isle of Man, and Gibraltar, which isn't an island. I need to remind myself.
Just a rock.
It's just a rock, and it's connected by land to Spain. But on the US side, US is very anti, and a lot of those external territories just sort of outside the US, Cayman Islands, Panama, Belize, that's where these things were happening.
Yeah.
On paper and physically, a bit of both. But, America's bringing it in, and Australia's saying, wait and see. We have great innovation here. Huge Web3 companies have been born from Australia. I can tell you without a doubt that their main entities and operations are not here.
Yeah.
And we've already lost it. All the stuff historically is gone. Can we move fast enough to capture the future? No, we can't.
Okay.
So we're focusing on payments, local exchanges, operations here, protecting consumers. It's low-hanging fruit. I think that consumer protection is 90% of the conversation. And I love protecting consumers, but that's sort of too much because there's not very much space to innovate.
Well, and it could be actually counterproductive. I mean, if you think about crypto, it's a 24/7 global market, and it's really breaking down barriers. There are no sovereign borders when it comes to crypto or blockchain. It doesn't matter where you are or where your clients are largely. And so that is leveling the playing field, I guess, from a lot of jurisdictions. But one of the unintended consequences of creating an over-regulated environment that's unattractive for businesses is that the growth will come from companies domiciled in these other jurisdictions, which means Australian consumers will just start consuming these products. And then if something goes wrong, well, then you've got to try and figure out how to take it to a court in the British Virgin Islands or in Panama or in Bahamas or Dubai. And it's like, so ironically, you're actually putting your Australian consumers, retail investors at greater risk.
100%. I guess it's a way to segue into the second part about that regulatory misalignment in sort of within departments and sort of within industry, between departments and inside the industry. And, ASIC was talking about markets licenses. Now, I think there's only 14 market licenses in existence. They cost millions and millions of dollars to get. And sure, that's great in that you've got highly regulated entities dealing with your cryptos. Well, the external view would say. The internal view would say, well, okay, you're going to stamp out 90% of those exchanges, which can't afford the $5 to $10 million in legal fees clients work to get there. Those costs flow back to consumers. I'm still going to use the shitty exchange overseas that doesn't have to do that, because those ones are still selling to Australians. And if they really wanted an Australian protected sector, then they have to choose the centrist path, unfortunately, which is work practically inside existing frameworks. Does getting AFSLs really protect consumers more? In some cases, if it's the right ones, and ASIC does the right stuff, but pushing them into a hyper expensive product, that might be where it fits legally. If that is, it should change. And I think it is changing. That's what the Treasury paper that came out last week said broadly, is AFSLs, not quite markets, AFSLs are the right middle ground. And I think that's about right. But yeah, there's clearly misalignment, which makes sense because you've got Treasury, which do policy, and then you've got ASIC that do enforcement. And the policy people don't tell the enforcement people what to do, except by creating laws, which they haven't done yet.
It's been kind of reversed in recent times, and we've been regulated through enforcement.
Yes.
Which is obviously what happened in the US with Choke Point 2.0, and that's all being repealed and thrown out of court. But it's created all these market inefficiencies, even civil liberty breaches around debanking, for example. I noticed the Treasury paper talked about debanking and said that's a problem and it's got to be addressed.
Yeah.
If you think about the value chain, you've got consumers, and we've already got about a third of Australians owning crypto. So there's somewhere between 6.5, 8 million Australians who own crypto today or plan on owning it in the next 12 months, roughly a third. So that's a lot. That means that it's already been adopted as a mass consumer product, investment class. And you can understand why when 9 out of the last 12 years, Bitcoin's been the top performing asset class. People do want exposure to that. The politicians should be then responding to that, because that's what their job is in a democracy. They should be reflecting the society's desires and values and representing that to push that into the legislation, which is what we're starting to see with Treasury, starting to say, well, let's go down this digital asset framework. But then it goes to ASIC, which is supposed to be the regulator, the enforcer, and they're saying, well, we don't agree with that. We don't want to do it that way. And so it seems that there's kind of like disconnects that all the way, every step of that process, there's just a misalignment. So by the time you get from one end to the other, it's just poles apart. Is that how you read it?
Yeah, this is common. This is common in, like I see it in tax, which I'm very deep in, in tax reform. The ATO is completely independent from Treasury and government. The retail punter might say, oh, ATO is lapdog of government. It's like, well, yes, but really they're given a set of rules, set of laws that they get to enforce, some strong powers, and they send them on their way. And their job is to collect as much tax as possible. Now, ASIC's directive is a bit more complicated. It's to create a fair, efficient financial system. So it's not just protect consumers; it's also protect businesses. It's a bit of a more complex priority. But the same thing, there's that disconnect. But I do want to talk about debanking, because I'm very passionate about debanking. I've been debanked personally at least 5 times.
Right. Is this why you started? Is it Blackbird, the fiat
Yeah, so Black Sheep, like that was born out of frustration. If you are a digital asset business, such as an exchange, getting access to banking rails is almost impossible. There's almost no, like if you Google it, you'll find a couple of providers. You go there, it's, tens of thousands of dollars to get basic banking facilities. And it's not just isolated to exchanges and digital asset businesses. That's probably the worst. But, remittance businesses are similar. Payments businesses have very complex needs on their banking. And it's not because there's a lack of providers, but it's just this risk of the AML, CTF laws, the anti-money laundering laws, creating all sorts of risks in the value chain. And we certainly need those laws. But when they result in registered businesses not being able to operate because they can't get a bank account, then we've got a problem somewhere. And government, they actually said many, many years ago, and this is Austrac as well as government, saying we're against debanking, banks shouldn't debank. And the response was like, well, the risk is on the bank. The risk is on the financial services provider. And the law basically says to them, if they can't put them in their risk framework that they're made to follow, then they've got to kick them off.
But the risk framework is, well, they have to be confident that the entity they're dealing with has undertaken proper KYC, KYB protocols, right? But if they're dealing with Australian exchanges or brokers who are Austrac registered, they're submitting they have to be compliant with KYC. Otherwise, they're in a lot of trouble if they're breaching it. Why isn't that enough for banks to say, okay, yes, show me your KYC processes, show me your compliance report. Okay, that's enough. I trust you like I would trust any other intermediary that I'm dealing with every day.
Well, you should never assume malice, stupidity, or incompetence. And I think it really is the closed-mindedness of the financial services sector still to crypto as an asset class. And this is part of why we're here. This is part of why you're doing this whole podcast as well. They don't fully understand, Bitcoin and stable coins as a threat to their underlying business models in transactions, payments. They don't see DeFi as a real threat to their loan books. But what they do see is things they don't understand. And when they don't understand it, and you've got the risk and compliance guy, they're going to say no every time. And I've seen exchanges, and I've worked with exchanges, and I've worked with financial services businesses. Most of those exchanges have much more intensive AML programs and risk matrices that they monitor in detail than a lot of those financial services providers do. Yet if you say I'm doing a property development managed investment scheme, off you go. Big Four bank, not a worry. No fees even for your transaction account. You say you're a digital asset business and you've done all the work, then the answer is no out of the gate, and you're at those tier 2, tier 3 providers. And you're getting extorted if you can even get one. And that's, a major competition factor. Just like the market's license is a problem, this is also a problem, although this is more insidious.
It is.
You can't really just shake this out with legislation because you have no right to a bank account in this country.
The interesting thing is, and for context, I worked at one of the major banks for 12 years.
I didn't know that. I love banks, Andrew.
And mainly in the wealth space. And I remember probably about 15 years ago running the retail brokerage business and did an assessment on Bitcoin. And I've been part of a number of conversations in the early days of crypto starting to form about should we pursue this. And now part of what you said is absolutely true around they don't understand it. And the majority of people still don't really understand the technical bits of it. So certainly not enough to say, how do we do this securely? How do we do this safely? How do we do this in a compliant way that's in line with our risk appetite? So that's absolutely part of it. But the flip side of that is also they won't do anything unless they can make a profit.
Yes.
So how do we make money out of this? And ultimately, every business case that I saw resulted in the bank making less money than making more money. Because what are you doing? You're decentralizing, you're removing institutions like banks out of that value chain. And the prize that a motivation because they take so much fees. There's a reason they make $10 billion a year in profit, right? Because they control the ecosystem. And DeFi and blockchain is an existential risk to a lot of those profit lines. So
do they really understand that though?
Yeah.
Okay. Interesting. Did they always understand that years ago?
Well, look, I can only talk to the rooms that I was in.
Yeah, fair enough.
But it's certainly I mean, look, it wasn't, you wouldn't talk overtly about it like that, but it was, if you want to do anything, you have to put a business case together and you say, why is this a good idea to do? How's it going to benefit clients, customers? How's it going to benefit society? All of that. But how's it going to make money? And if you can't demonstrate how that's going to make money, you don't do it. So it's not like they're sitting in dark rooms, plotting against, undermining cryptocurrencies or anything like that. No, but they're not going to push things that are going to compromise that.
Do you remember years ago when the big yellow bank, we won't mention any names, had that potential partnership with a large US exchange, and it all sort of fell over? And that was a really interesting signal because they clearly wanted them in the room if they could bring it into their securities platform and offer those assets and take that spread. Like, exchange businesses make great money.
They do.
Don't be fooled. If they can get everything going, like, they make pretty good money. But then that didn't really eventuate, and there's some reasons for that. But that interest kind of never came back, and that was always really surprising.
Mm-hmm.
It's been so long since we've heard of those sort of deals. Do you think the banks are looking into it though, mate?
I guarantee they're looking into it. And I'll tell you why, because you look at what's happening in the US, all right? And so the US, so you got Trump coming in wanting to set up the US as a crypto capital of the world, but he's done a bunch of things already, like strategic Bitcoin reserve, blah blah blah. But what he's also got is his crypto working group coming back with a new regulatory framework by August. Now, what that means is that hopefully will give regulatory clarity. Now, any of these big financial institutions, that's what they need. They can't do anything unless you've got regulatory clarity.
Well, they had
because
that
they're
bank
too
thing,
big.
didn't they? What was they couldn't keep crypto assets on their balance sheet, but now they
Yeah, that was the SAB 121, the SAB 121, which basically said you can, but you had to treat them as a liability.
which is weird.
No, it's not weird. It's destructive. It's basically saying, we do not want you to go anywhere near this. And so it's not just saying you can't treat it as an asset. It's saying if anyone's got 100,000 in Bitcoin, you've got to treat that as a liability. That goes against their lending assessment. So you're paying higher interest or you're not getting access to funds. So it's actually building in a deliberate market disincentive around this asset class. Now, why would they do that? Well, let's not go down the conspiracy theory path, but geez, it looks like a duck.
I'm not a career conspiracy theorist, but now I'm in the payments industry, which is a new industry for me. And it's been 18 months. Like, it's really slow going. I can see why innovation in payments is really difficult, because the amount of fingers in pies,
Yeah.
if you push it too far, then you have serious problems. And like, there are banks looking into those new asset classes and those new arrangements around tokenization. I've been very reluctant with tokenizations. A big example that people talk about is tokenization of Australian real estate. And you go, well, why? What's the purpose? The only purpose in my mind is liquidity. And that doesn't help the banks, now you mention it, because they want to write more loans.
I look at it and I think, okay, when you buy a house, you've got to go through about 7 different intermediaries just to complete the transaction.
Yes.
And they're all got fingers in the pie and they're all taking a slice, and it's just cumbersome and it's time consuming. Things go wrong. You have to, miss settlement or whatever because you're dependent upon all these other parties. Now, blockchain smart contracts, now, they may not be able to strip all of that away, but they can certainly simplify that. They can certainly streamline it and reduce a lot of cost and a lot of ambiguity out of that process. I think that, I think that real world assets or digitalization of tokenization of assets is a really interesting trend that will grow. I think it's going to go slow. It's going to go slower than what people think, and then it's going to go faster than what people think. It's going to hit a tipping point where suddenly it just goes, right, this is now accepted and normal, and everything will just get switched across in record time. But it's going to take longer to get there than what people think.
Yeah, it will. Did you see the announcement? I think it was from the NASDAQ that they're going to trade 24/7.
I did, yes. But no, 24/7, 5 days a week.
A week, yeah. So they like, a big market was that, sort of overnight trading. huge stuff happens there. It's great signals, better than futures and perps and things. But it takes the flip of a switch, and then suddenly that market's eaten. And I think the same really goes for that liquidity argument. Is if I've got illiquid private crap and I want to be a market maker, like, why would I go market make that for set fees when I can do it in the current systems? It's sort of like the bank thing. It's like, well, the incumbents will check their turf. Tokenization, though, I have been seeing a lot in the private credit space.
Okay.
Where people are fundraising via debt, and then they, on lend, and they get quite good efficiencies there.
Right.
That's where I've actually seen really good uptake. And tokenization, stable coins I actually put into the tokenization basket because we're tokenizing US dollars or other dollars. And that's created massive payment efficiencies.
Yes.
Which is, apparently that's going to be the key to USD dollarization dominance, which kind of makes sense to me. Is if it becomes the preferred payment thing still, then where we are right now, except it's USDC, not USD via wire transfers, which is a net improvement because dealing with USD is a pain in the ass.
Well, it's separating the store of value from the commodity or the tradable, exchange of value elements of money, isn't it? If you want to transfer $10 million from one side of the world to the other, it's going to take days and cost you hundreds of thousands of dollars in fees to do
Which
that.
Which boggles the mind still. I don't think people actually really understand this.
Yeah.
I had a client once. He tried to move over $1 billion from Switzerland to Australia. Yep. It took a team of 3 lawyers from my side, just acting in Australia. It took a team of 5 in Switzerland. I think it took about 4 or 5 banks. I think he paid about 2 or 3% in fees, which is millions and millions of dollars. They didn't go to me. They went to the bank that they're processing the payments. Payments is actually really hard. Moving money across the world,
it's really profitable.
They're really profitable because they can, but then now it's not with these stablecoins, which you can send hundreds of millions of them instantly
at hardly any cost.
Yeah. The cost is based on transaction, but not the size of it.
That's right.
It breaks so many models.
You look at the utility of that, and pretty much every participant in the market is now saying, yes, stablecoins are going to take off in 2025 because people recognize that upside and that benefit, and they can quantify the positive use case. I think that's probably been one of the detractors of crypto up until now is a lot of people struggle to be able to articulate the positive use case. And I think meme coins, for example, have really undermined that. Because
they have, as fun as it was.
Yeah, as fun as it was. Well, I mean, it's got a place, right? It's fun and there is a science to it. And who are we to say that it doesn't have value in the world? There's plenty of people who are voting with their wallets that it does have value. It's not hard currency though. Every other asset that we're used to, if we look at an asset that you're thinking about buying, how you assess it is you say, what value is it creating? Yes. What's the value that it's creating? And is that going to create enough value that it's going to increase over time? And if so, I'll buy it. Meme coins, they're not creating any value, and they're unashamedly not creating any value, and apart from maybe a sense of community.
Well, it's funny. I have a really contrary view on meme coins in that they're an essential part of the system. We wouldn't have Bitcoin unless we had the Silk Road drug dealers shitposting on 4chan. And that's the technical term of what they were doing and still do. And now it's this, global currency hedge, which is still questionable. But it's certain there's value in the Bitcoin protocol. People see it. A lot of people see it. Same value as it was back then. It's just it was a joke back then. And now it's not. And there's a few examples, and these are the exceptions that don't fizzle out into obscurity. The Bearer NFTs became Bearer Chain, which raised $140 million and created a new layer 1, which is doing some really cool stuff. That was from some silly NFT project when the bear market started, I think in 2019. What meme coins seem to encapsulate is just these little niche cultural zeitgeists of what's happening in a particular thing. And some of them are complete nonsense, and that's fine. They don't really do an awful lot. But there's CZ's dog is a meme coin. It does pretty well, actually. Fartcoin has got a bigger market cap than most ASX companies.
Peanut the squirrel went to whatever 40, however many billions of dollars.
Yeah. Yeah, Trump coin, that's a whole can of worms, obviously, that one. There's like, it's grabbing some value and it's moving it. And that we've got to go, what is it? It's something.
There's definitely some. With meme coins, how I describe meme coins is I compare it to music, and
Yeah.
I say meme coins is the punk rock of crypto. So you remember when punk came out in the 80s, and it was like a headbutt to conservative, music. It was a knee between the legs. It was, all spiked hair and chains and piercings and screaming, and they're not trying to create music. They were rebelling, right?
Yeah.
And they were anti-establishment. They were literally degenerates, right? And what happened is it created a sense of community because there was a lot of people disaffected with society, disaffected with music because that reflects society. And so they all galvanized around punk rock and formed a community. And I think that that's what meme coins is doing for wealth creation. There's a lot of younger people who feel locked out of wealth creation in the world and they're rebelling against it. GameStop, that was a rebellion. Occupy Wall Street movement. This is all like them rebelling against traditional wealth creation, saying, you guys have got it all locked up to the older generation and you're blocking me from being able to participate. I'm going to create my own way to be able to create wealth that is deliberately provocative and in your face, because I'm angry.
Yeah. It's fun. It's fun to watch, like I do a lot of private advice and like work with meme coin founders, both ones that have made a lot of money and ones that have done absolutely nothing. The ones who haven't done very well don't need a lot of my services, but there is serious value being captured, and I think an investor dismissing them as crap is what they were saying about Bitcoin 10, 20 years ago, 10 to 12 years ago. It's the same sort of thing, and you just need to be very careful. Like, these things age very badly when you make these statements, like these sweeping, generalization. They're usually wrong. I think that's the way I normally describe generalizations. But the fact of the matter is, should you be buying meme coins with your SMSF? And probably not, because I think the pump fund statistics were less than 0.04% of traders actually made money on pump fund.
That's right.
And that's worse than CFDs, which are banned.
Well, it's extreme volatility. So should you be putting your retirement savings in extreme volatility? No. But I think that one of the key lessons to investing that a friend of mine taught me a while ago was that you don't have to like it or even agree with it. You just need to understand the dynamic. It's like Trump. You don't have to like Trump or hate Trump. It's irrelevant what I think of Trump, but I sure as hell need to know what he's up to and have a view on what impact he's going to have on the world, because he's shaping so much, it's impacting markets. Being able to sort of separate your personal emotion. I used to get quite offended by meme coins coming from a traditional finance background,
That was
when
the
they
point.
first came out. Sorry?
That was the point. Like, it kept the traditional market out.
Exactly.
Like, my favorite coin was called Scam Coin, and you can't be a VC fund buying Scam Coin. You just can't. That's why he called it Scam Coin.
Yeah, exactly. It's the subculture, and that's the message. You need to put your own personal feelings aside and say, I need to understand what's going on here, and then decide, does this have a place in my portfolio or not? Now, if you're a 20-year-old kid who's got their whole life ahead of them and they've got $500 to invest, then maybe it has a place in your life. If you're 50 plus and you're trying to tip in, 90% of your super into a meme coin, maybe it doesn't.
Unless it goes up, and then it was good. But it's sort of like all seriousness. Like, it all comes back to that fundamental analysis about, like, well, what is the value proposition of, this ASX or NASDAQ company or this crypto asset?
Yeah.
And sometimes that value it's got a really strong community. Which has got a really strong buying power. My favorite one, and this only happened last week on Thursday, is they announced an ETF for the Pudgy Penguins NFTs and Pengu token.
Yeah, I saw that. I saw your post on that.
Yeah, I was like, this is like, that's the tipping point. That was the best news from Friday. Australian government announcements, border tax, like, whatever. But seeing that there are institutional providers who say, I want to wrap up some complete meme stuff into an ETF, and we think there'll be inflows into it. If that's not a bullish signal that all of your old conceptions about crypto need to be put aside, and actually you need to look at what's in front of you right now. I don't know what's going to actually change people's mind, because like Pudgy Penguins, that like it was dead. That was a dead NFT project years ago. I watched the slow death on Twitter, and then it got rebuilt from nothing, and then they launched a token which is worth quite a bit. I got a nice airdrop of Pengu tokens. Thank you very much. And then like there's an ETF like that. That wasn't what I expected to be the next news.
There will be some people who don't ever recognize the value in crypto, and that's okay.
Yeah.
Like there's always going to be people who it's just out of their risk profile, out of their comfort zone, and that's perfectly fine, right? There's nothing wrong with that. But I think that the fact that you're looking at ETFs, just a reflection that the institutional banks have flipped 180 degrees in the last 2 years, even from doing everything they can to talk down crypto and badmouth it, to now saying, well, the horse has bolted, we might as well jump on, strap the saddle on and ride it. And so now BlackRock's Bitcoin ETF is the fastest growing ETF in the world ever. It overtook their gold ETF, which was a 20-year-old ETF, in 6 months, and now has nearly doubled their gold ETF in funds under management. So it's the institutional banks have seen, like I said earlier, they look at how can we make money on this, and absolutely they can make money. So with the US really pushing to become the crypto superpower of the world, I think you're going to see ETFs spinning off for everything, just like they have with equities in a very short period of time.
Just like there's people, all they do is buy precious metals in their super funds, and they hate equities. And I know that makes you as, an advisor, like sort of die inside, because, equities are really where the value unlock is. And like that's where business and economic growth is generated from, is those businesses. Shit-canning any asset class is going to leave you burned, which doesn't mean just invest in everything. It means, unfortunately, you have to actually turn your brain on and think about things and assess things, which is really annoying, because the days of we could buy a ETF and that's the end of it, I think they're coming to an end.
Yeah.
I think we're in a sideways trading pattern for quite a while on that, which doesn't matter if you're in it for 40 years. But if you've got 10 years left on the portfolio, it actually is time to change that risk and go, do I want to have, essentially 60% of my SMSF in FANG companies, or whatever the FANG acronym is now? Change it. I think there's a T in there now, I think. You probably don't. You're overexposed. Just like you don't want to be overexposed to crypto, you've got to understand the timeline, which I think is actually impossible. If someone says Bitcoin's going to go up tomorrow, I don't think you should believe them. If someone says it's going to go down tomorrow, I don't think you should believe them either. I think it's like you need to go, well, risk adjusted. Am I willing to do with that asset class? And it should be a small amount to start as you sort of go into it. Meanwhile, I've got clients that, have like this SMSF is 50% Bitcoin, 50% ETH. That's it. Which is probably not a horrible strategy. At least it's not mean crap.
I don't think the ETH they'd be very happy with their ETH at the moment. But
no.
I think the first question I always ask people when they start asking about crypto is, what's your time horizon? I mean, it's a very volatile asset, and Bitcoin is the least volatile out of them. And so you get down into the small, low cap speculative plays, and it's hyper volatility. And so that's exciting. It's dynamic. You can ride the upside, but you can also lose a hell of a lot in a very short period of time as well. So you have to understand the cycles. You have to have a timeline that allows you to ride through the cycles, and you need to have a risk appetite. That means that you're not going to blink when you're in the depths of a bear market.
Yeah, or you buy when it's okay and you sell when it's 70. Like I see people do it all the time.
Yeah,
I'm
lots of people doing it right now.
Yeah, like I'm very popular at parties when Bitcoin's at 100K US, and then I'm not very popular when it's at 20. Like for instance, I'll tell you a story. So I was in Sydney until 2023. I moved up to Brisbane. Tax lawyers are priced out of the Sydney housing market. I think if there's a canary in the coal mine, I think that's it.
Wow.
But like Bitcoin was at like 20K. And like I've actually bought very little Bitcoin in my career, but I'm just like, yeah, like I really should. But I was like, I actually can't. Like it was the wrong use of my cash. I needed it for the house deposit. And then once I had that done, I had very little cash left over at that point. And it was like, should really buy Bitcoin at 20K, 16K. I'm just like, just can't. But there's always more opportunities.
And I think educate yourself as well. So, shameless plug time. But I mean, that's what I set Synergist up to do, is to provide independent education so people can get informed enough to decide whether crypto investing is right for them, and if so, the right way, without drilling into a whole lot of detail, but just enough information to say, what's your time horizon, what's your risk appetite, which narrative do you like the sound of between DeFi or real world assets or meme coins even, but and giving them a framework to be able to build out their investment strategy and get in the market, because that's the best way to learn.
Yes, exactly. And it's just like the days people were selling property funds and they were selling actively managed investment funds and all sorts of things. Like investors will still need to get proper independent advice.
Yeah.
And their proper independent knowledge of stuff. Because if you go and ask the property guy, what should I buy? Don't be surprised when he says property.
Yeah.
And if you ask
his property.
Yeah, his property, this one right here for 20%, it's going to go up. So there's no substitute for educating yourself. And that's really all there is to it.
It's one of the investment principles of all time. If you don't understand it, don't invest in it.
Yes.
All right. Well, look, Harry, that sounds like probably a pretty good way to close off. We've gone a bit over time, but so I don't want to keep you all day, but I really appreciate your time and your insights. It's been fascinating.
Thanks for having me on, and really good initiative doing this.
Thank you. I'll bring you on again in the future.
Sounds like a threat. Thanks, Andrew.
Thanks, Harry. See ya.
Yeah.
This podcast is for informational purposes only and does not constitute financial advice. All views of Andrew McPhee and his guests are their opinions only and do not reflect the opinions of Synergist. You should not treat any opinions expressed as a specific inducement to make a particular investment or follow a particular strategy.